Hey guys, I'm going to talk to you guys real quick about something that may be seemingly obvious, but I want to just really go through the differences real quick. We hear a lot of talk about business credit versus personal credit, but what really is the differences between the two and how are they different? A lot of people think it's just, oh, business credit is the credit associated with the business, where your personal credit is your personal credit, but they are totally separate, and I'm going to talk to you about those differences. So think about this: when you've started a business and when managing the finances of your business, it's important that you understand the difference between business credit and personal credit and how it affects you. While both types of credit play an important role in your financial life, they serve different purposes and are governed by separate rules. Confusing the two can lead to complications, especially as you grow your business and seek financing. So in this video, I'm going to break down the differences between business credit and personal credit and why it's important that you separate the two and how to manage them both responsibly for long-term financial health. So boom. Business credit. Business credit generally refers to the credit profile associated with your company, your business, separate from your personal finances. Just as individuals have your personal credit scores based on borrowing and repayment history, businesses have credit scores that reflect how they handle financial obligations. Your business credit profile is used by lenders, suppliers, and potential partners to assess your company's financial reliability. It can impact your ability to secure loans, negotiate payment terms with suppliers and vendors, and even attract investors. Of course, what is personal credit? Personal credit refers to the credit profile associated with you as an individual. It is based on your personal borrowing history, your credit card usage, personal loans, mortgage payments, all of those things. Personal credit scores are used by lenders to determine your individual credit worthiness when applying for a personal loan, like a mortgage, a car loan, or a personal credit cards. Now, both personal and business credit scores are tracked by major credit bureaus, but they are used for different purposes and have different implications. So, let's talk about the key differences. I'm going to talk to you about the key differences. It's purpose, first of all. So, key differences between business and personal is purpose. The primary difference between business credit and personal credit, it lies in the purpose. Business credit is used to assess the credit worthiness of your company, not you as an individual, but the company. It is based on how your business manages its financial obligations, including trade lines with your suppliers and vendors, as well as business credit cards, loans, and lines of credit. Lenders and suppliers will use your credit score to determine whether your company is eligible for financing in favorable terms. Now, of course, with personal credit, they're looking at your individual credit worthiness. Personal credit scores are based on your use of personal credit cards, loans, and other types of individual debt that's in your name. Now, lenders will use your personal credit score to evaluate your ability to repay personal loans and lines of credit. Okay, let's talk about the credit bureaus involved between personal credit and business credit. Both business and personal credit is tracked by credit bureaus, but there are key differences in which bureaus report on which different type of credit. Now, the major bureaus for business credit include Dun & Bradstreet, Experian Business, and Equifax Business. These bureaus track your company's financial activities and create a business credit report, which includes your business credit score. Now, of course, you're probably familiar with the fact that on the personal credit, the major credit bureaus are Experian, Equifax, and TransUnion. Now, of course, we know that these bureaus monitor your personal financial activity and assign you a personal credit score based on your individual borrowing and repayment history. Now, while Equifax and Experian both track business and personal credit, they do maintain them separately, which means that your personal credit report won't include any of your business activity unless a personal guarantee is involved in that business loan. So let's talk about the scoring models. I've talked to you before and explained about scoring models such as FICO and Vantage. All right. So the way credit scores are calculated is different between personal and business credit. So with business scores, this credit score range is typically between 0 and 100. Now, of course, a higher score being the better credit worthiness. Now, Dun & Bradstreet uses what's known as a Paydex score to measure payment history, while Experian Business and Equifax Business use a proprietary scoring model that assesses factors like credit utilization, payment history, and public records, very similar to how they measure the personal credit scoring. Now, of course, with personal credit scores, you probably know that you're aware that the general scores run between 300 and 850, with higher scores being the lower risk. Now, both FICO and Vantage are the two widely used personal credit scoring models, with FICO 8 being general lending, FICO 2 being used exclusively for mortgage lending, and then Vantage is used generally amongst lenders, some lenders, and most credit score monitoring use them as well. Now, those two take into account factors such as pay history, credit utilization, length of credit history, type of credit used, and of course, recent inquiries. So, of course, the personal model is much more broken down and taken into account a lot more factors than on the business side. So, how do they each impact your personal assets? Now, one of the biggest differences between business and personal credit is the potential impact on your personal assets. Now, with business credit, if you've established your business as a separate legal entity, such as an LLC, S Corp, or C Corp, your business credit activity is generally separate from your personal finances. That means that your business debts and your business obligations don't directly affect your personal credit score or your personal assets like your home or your car. They are protected from business liabilities as long as you don't provide a personal guarantee. Now, of course, with personal credit, that is directly tied to your personal assets. If you default on a personal loan or a credit card, it can negatively impact your personal credit score and lead to a collection action that could jeopardize your personal property. However, if you provide a personal guarantee for a business loan or line of credit, your personal credit can be affected if your business is unable to repay the debt. Personal guarantees are common for small businesses that don't yet have an established credit history. Now, I have a strategy involved which will allow you, and it takes time, to build up your personal credit without the use of personal guarantees to greatly reduce that. And if you follow this system, it'll guarantee that. Now, there are ways of getting business credit earlier and quicker, but that required the use of personal guarantees. So depending on how fast you want to start getting business funding, you want to consider that. Now, I recommend a strategic approach and try to avoid the personal guarantees, especially if you have assets that you don't want to put at risk, such as a home. Now, let's talk about reporting and transparency. Both business and personal credit differ in terms of who can access your information. Now, a lot of people don't realize that business credit reports are considered public information, which means that anyone without any permissible need or requirement which includes lenders, suppliers, potential partners, and even competitors, can access your business credit report. Now, this transparency makes it important to maintain a strong business credit profile as it reflects your company's financial reputation. Now, of course, with personal credit, those reports are private and can only be accessed by authorized parties such as lenders and potential landlords, and only with your permissible use. This means that your personal credit information is more protected and fewer people and business and organizations have access to it as compared to business credit. So why is it important to keep business and personal credit separate? As a business owner, keeping your personal and business finances separate is crucial for the protection of both your credit scores and your assets. And here's why. One of the biggest benefits of establishing business credit is that it shields your personal assets from business liabilities. If your business runs into financial difficulties, creditors can't come after your personal property. They can't come after your home or your car or your savings account if your business is structured as a separate legal entity, such as an LLC or corporation. This protection doesn't apply if you're using personal credit for business purposes or if you've provided a personal guarantee on the business loan. You can establish credibility for your business. So, by building a strong business credit profile, it is essential that you do so to establish credibility with lenders, suppliers, and investors. A solid business credit score shows that your company is financially responsible and capable of managing its obligations. Without a separate business credit history, your business may rely on your personal credit, which can limit your growth and limit your opportunities and make it harder to secure financing. Separating them can give you access to better financing options. Businesses with strong credit scores can access better financing options such as lower interest rates, higher credit limits, and more favorable repayment terms. You might be able to get 30 days, 60 days, longer terms. Net 30, net 60, which is better than net 30. So imagine buying something now, having 60 days to pay for it, interest free. That's great. That's almost as good as on the consumer side, the 90 days same as cash type options. By maintaining the separate business credit, you can build a credit profile that opens the doors to these opportunities without affecting your personal score. Separating them can simplify your tax reporting as well. Keeping your business and personal finances separate makes tax reporting easier and more accurate. By using a dedicated business banking account, business credit and business credit cards, you can clearly track business expenses, making it easier to prepare financial statements and file taxes. So how do you build and manage separate business credit? Building and managing that business credit requires a strategic approach, as I mentioned. But here are a few tips you can establish and maintain a strong credit. I do have more on that in detail. First of all, you want to form a legal business entity to separate the two, as I mentioned, LLC or corporation. Secondly, of course, you want to open a business bank account by keeping your business and personal finances separate. The business account is dedicated for all business revenue, income, and paying of bills. You want to apply for business credit. You want to start building business credit by applying for business credit cards, lines of credit, or loans. However, you want to do it strategically and start with tier 1, which is typically your vendors and suppliers, and build up your credit score so that when you apply for business lines of credit and credit cards, you have developed a minimum credit score to ensure your approval Because if you apply for business credit cards too soon, you'll end up with a lot of denials, or you'll be forced to have to take the business credit using a personal guarantee. So be sure that you choose lenders and vendors that report to the business credit bureaus and that will not require personal guarantees. Of course, you want to pay your bills on time, just like with your personal credit. You want those timely payments are essential for building a strong profile. Make sure that all your business-related bills and invoices are paid on time to establish positive pay history. And then, of course, like on personal credit, you want to monitor your business credit and regularly check your business credit reports from both Dun & Bradstreet, Experian Business, as well as Equifax Business, to ensure that all of your information is accurate and up to date. So, understanding the difference between business credit and personal credit is crucial for managing your company's financial health and protecting your personal assets. By keeping your business and personal credit separate, you'll not only safeguard your personal finances, but also position your business for better financing options and growth opportunities in the future. With the right approach to building and managing your business credit, your company will be well equipped to thrive while your personal credit remains fully protected. So that's that in a nutshell. So keep that in mind as you're going forward and building your business. Now, if you liked this video, if you found it helpful, please like and comment below. If you know someone who would enjoy this video or find this information helpful, please share the video using the share arrow below. And I would say if you enjoy this video, there's tons more, and I would ask that you subscribe to my channel and then send me comments and let me know what else you want me to talk about. So for all you fellow entrepreneurs out there who are looking to get your business credit in order so you can get proper financing to get that business going and growing, feel free to watch more of the series, and good luck to you. I'll see you in the next video.